Right on. So the recording is on. Welcome everyone to another session here. We are kind of going to switch these up to Sundays from now on. Just a lot going on the Saturday mornings and afternoons in San Diego here. We've kind of fully moved into my new place. So I think Sundays are just a little bit better. We're going to try and stick to the 12 p.m. Mountain Time. It seems to work. And worst case, everything is recorded. So I think for those who aren't able to make it or are adjusting their schedule, or it's summertime anyway, people got lots going on. So we'll make the best of it we can. This one's kind of an interesting session here today because I think after this session, I've basically hit every company that I'm tracking for the last 6 months. It'll be about 50 companies that we will have hit. With different sessions. Some of them were covered twice or 3 times even, but it's kind of at the point now where everything's kind of covered. So I might try and switch these sessions up a bit, talk more about some of the newer wells, some of the new junior plays, companies that I haven't covered in the past going forward. But on the overall, just kind of keep them going once every 2 weeks, and then have the macro outlooks every couple months or so with any new information that comes out, and kind of keep them going. So pretty interesting time here. We just finished earnings season with Vermilion on Thursday and a couple of other names. There are still some junior names still to report, but on the overall, I think everything is out. The WTI averaged, I think, 108 for Q2, so a number that I think a year ago or 2 or 3 years ago people would have laughed at if you would have suggested that this was on the way. So pretty good earnings, and you're kind of seeing companies fragmented now, where some of them are in their capital return plan, some of them have a growth wedge coming online, some of them are still in that debt pay down mode. You're seeing companies become cash taxable. You're seeing the royalties go up. You're seeing operating costs go up in certain companies. So it's a really interesting time, I think, more so now, because if one believes a macro that's kind of upon us and you're looking to see where things are going, and a few acquisitions as well happening, kind of major M&A. So, if you're kind of looking to set yourself up here for the cycle, it's going to really depend on whether you're a short-term investor, you're a trader, you want to look 3 to 5 years out, you want to look at the junior companies. Kind of what you're targeting is I think going to make a big difference. Like, rising tides lift all boats, but there's going to be certain companies that do better as the cycle goes on. We're seeing companies that announce major dividends are doing really, really well after the dividend announcement, and we're seeing M&A kind of not being rewarded right away, but maybe as a long-term investor, that's something more suitable to you. So, worth spending the time on. It's also one of the reasons I haven't updated my White Tundra holdings here on the website. I know I've got quite a few messages, but I'm just in the middle here of running some new models and possibly changing out a couple positions, adding to certain positions as I kind of see the cycle go on. I also think, this is just me personally, it might be worth trading in and out of some of the positions, front running some announcements, especially the capital return to shareholder plans. So just playing around with some ideas around that, and kind of how I want to set myself up for that. So I do apologize for that. I will get the updated holdings here. I'm hoping in the next couple of weeks here as I change up the portfolio a bit, and kind of go from there. So few things up front. I'm not an investment advisor, so everything I share today is my opinion. It's based on data and my interpretation of what I see happening. So please do your own due diligence. Please check your portfolio construction and your risk tolerance, the 3 things that are absolutely essential, especially in this sector. So I do say that not just to put that out there, but as something that I think is quite important. The June to July drawdown we saw, I think even people that really did due diligence were not really prepared for what happened there. But for people who have been in the oil markets for a while, it can happen. We have low liquidity to begin with. We have pretty low interest in the sector to begin with. Some of the companies are still in the middle of their kind of return plans. So there's this lag almost in there. And the broad markets, there's just so much going on in general that it's just more important than ever to make sure you know what you're investing in, you have conviction, you understand it, and so forth. I also do have a mailing list going, so we have quite a few people on there now. So if you want the files that I'll be talking about today, these corporate presentations and the MD&As and whatnot up front, along with the Zoom link, please shoot me a DM and we'll get you on there. There are some emails that got missed, so I will try and get those on there. And there's also an issue that's happening where some of the files are too big. So I'm getting about 10% of the emails I send them out to are getting rejected because the receiver side is not accepting files that big. So not really sure how to fix that, but I will try compressing the PDFs a bit, and maybe that'll help going forward. But yeah, please DM me or email me. And as I said, the recordings of both the the recording for the Twitter space will be on Twitter. The recording for the Zoom link will be on YouTube to begin. I will get them on the website here shortly. There's been a change that they made to the way the drag and drop system works on the website. So some of the links are getting messed up, but just trying to keep up with all the new technological changes and coding that they keep making to all this stuff. So bear with me. And I also have got some really good suggestions in the last couple of weeks on different things to add to the website, different videos to make. So I do appreciate them. Keep them coming. Everything I do is pretty flexible. So if there's a certain company you want me to cover, there's a certain type of session or webinar you would like to see in the future, please let me know. I love suggestions like that and can kind of cater the content to what people are most interested in. And I am also planning, I know there's been some meetups going on in Canada, Calgary meetups with the Canadian oil mafia and the other oil investors, and in Toronto now as well. So now that I'm kind of settled down in San Diego here, I do want to get kind of not that often, but some sort of meetups going, so we can kind of talk oil down here every so often. So if you are in the area, please reach out to me as well. We can get something together and get a little group going. Always fun having drinks and talking oil. So with that, I'll get started here. I am updating the price target spreadsheet for Q2 results. Should be out by the end of the week here with every company that's released. And yeah, kind of update them a bit. It's the first time we'll see that the current oil price is below the last quarter oil price. So there is a little bit of difference that's going to be kind of showing up there, but we will kind of see how the model works in this case, and I might make some adjustments and kind of go from there. Okay, so there's a question here. Did you take out the stay flat capital? Yeah, so out of the spreadsheet, it is gone. It's a hidden cell now. So between 17 and 22, you see here, I got a few cells hidden. And I think honestly, what I'm finding is I want to make my model as simple as possible. And then people are doing their own adjustments in there, and people are running their own graphs, their own tables and models. So I'd rather have my generic model very simple. This is not the model that I always use. I've got my own adjustments in my seminar calcs model, but for the purpose of the presentation, I want to keep things simple. I do find it's helping by removing some of the extra boxes. So Tillman, if you do want the full spreadsheet, I can definitely email that to you. But for the sake of the ease of the seminars, I've tried to simplify it down even more than what it was before. But yeah, thanks. So today we'll be discussing three companies that are kind of juniors, you could say. They're in big, mid to big growth phases, a little different than the rest of the industry. And the reason I picked these companies in particular is because what happens in cycles like this is a lot of the non-core assets that are divested by big companies are picked up by these little juniors. They pick them up and they actually have the time and the effort and the money really to properly capitalize them, get workovers done, get some infill drilling done, work on water flooding. And if the big companies were to focus their time on this, they would add 1-2% of their production. Big deal. It's just not worth the time. Whereas for smaller companies, they can grow their production by 20, 30, 40% by doing the exact same thing. They're just smaller companies and they have more time to spend on the little details that the big companies just don't care about. So, ROK Resources, they bought some assets from the Federated Co-op team, and Saturn Oil, they bought some stuff from Crescent Point twice now, I believe. Twice now. So, focus on that. And then Petrus is kind of looking at some of the older Cardium, some of the fringe edges where other companies just were not interested and are kind of going into that. So pretty interesting, because these are the kind of companies that if they hit a good field or a good extension of a field, it could make a pretty significant impact to their production, to their cash flow, to their free cash flow. It's not only a financial play, but it's also a geological engineering bet you're taking. So I really enjoy companies like this because I like going into the nitty-gritty. I like looking at where their abandoned / suspended wells are. Where can they go in and do some workovers? Are they next to some other drilling? Are they extracting oil from old fields that just got ignored for the last 8 years? Nobody spent money on it. Now it's kind of worth looking into. So we'll discuss these today. Before I start, I want to make some points here, a couple points here on the market, the broad market, and kind of what's happening. So we've seen a lot of new investors enter the stock markets from 2020 onwards, 2020 and 2021 and 2022. And I'm seeing a lot of narratives being repeated over and over that are not backed up by data. It's just what the media is telling people. I'm seeing very, I don't want to call them famous, but very followed Twitter accounts that are just reposting the same thing over and over and over. And it's got hundreds of comments and thousands of likes about the broad market collapsing and this happening and that happening. So I'll just share a couple things here. Before I get into it, for anyone that joined late on the Twitter Spaces call, if you want to join for the Zoom visuals, whitetundra.ca, scroll to the bottom under events. The Zoom link is on there, and you can check out the visuals as well, along with the audio. So let's talk about the most people are living paycheck to paycheck narrative. I just saw it this morning again, the same thing again by a very popular Twitter account. And here are some news articles. 2003, November 17th, 2003, Wall Street Journal. More people are living paycheck to paycheck. Weak economy, rising healthcare costs. 2015, 55% of US households are living paycheck to paycheck. 2012, Reuters, more than 2/3 in US live paycheck to paycheck. 2007, same thing. 2008, CNN, CNBC, 2009. People making more than $100,000, the rich people are living paycheck to paycheck. 2015. Canadian households are living paycheck to paycheck. 2013, 2010, Business Journal, CNN, 2013, 76% of Americans living paycheck to paycheck. Middle class, 2014. Even millionaires are living paycheck to paycheck, says CNBC in 2015. Forbes, 2019, 78% of workers are living paycheck to paycheck. So it was 78% in 2019. Now, supposedly, the exact same websites are saying it's 64%, but they're making a big deal out of it. Like, oh my God, look at this. The American economy is collapsing. The consumer is not doing well. Recession, inflation, the buzzwords that you all know. Half the Americans are living paycheck to paycheck. This is 2022 results. So basically the point I'm trying to make is these things have been the same headline for 20 years, the exact same headline with some randomly generated number based on a survey of 100 people or 1,000 people. And the only reason it's getting more attention now, we have more people in the market. We have more people who are trading, who are swing trading, day trading, playing options, reading these news headlines, who are on Twitter that are keep pushing the same headline over and over. But these news websites, they know what sells. They know what's going to get the likes. They know what's going to get the retweets. They know what's going to get the shares. It's these hyperbolistic headlines that they've been pumping out for the last 20 years with the exact same headline. So if you're going to go on Twitter Spaces, or you're going to message me or DM me that, what do you think about this? It's a concern to the economy. I will give you one suggestion. Before you ask anyone, just go to Google, put the headline in, and put 2001, 2002, 2003, 2005, 2010. Just at the end of the headline, put the year in, and try to find other articles that are saying the same thing for the last few decades. It doesn't mean anything. They just want clicks, and they keep saying the same thing. 2016, right here, oil sucks stocks down as global recession fears bubble up. 2011, oil drops on recession fears. Oil down, this 2012, oil down as US economy fears reemerge. It's the exact same thing. I could find any narrative and just search by year and find the same headline year after year after year. So I think I've made my point on that. Margin debt. Margin debt is down big time in the last, call it 6 months. The reason I talk about this is people are saying money has moved out of the market, et cetera, et cetera. There's a lot of money sitting on the sidelines is what's happened right now. You look at the last week and people are getting confused. Well, how come the S&P keeps going up, even though it's a recession, even though it's inflation? These things don't mean anything. When we look at the data, there's a ton of money sitting on the sidelines, waiting to come in, and I'll leave it at that. I'm not going to make any comments on what that means, but the data shows we're not really in a bubble-like stock market anymore that we were at the kind of the third to fourth quarter of 2021. So let's talk about the Chinese real estate crisis. So people are saying, oh, China is basically dead, and due to that, oil demand is going to go down. 2010, China's post-crisis housing bubble. 2011, China housing bubble. 2004, China price hike. 2011, housing bubble. Shanghai real estate is the most obvious bubble ever. 2010. Could China's real estate bubble burst? Blah, 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 blah. It's like every year, 2012, 2013, 2014, 2016, 2017. It's the exact same point I'm trying to make. People have been trying to predict the Chinese real estate property collapse for the last 20 years. Has anything really happened? I don't really think so. And in fact, it's funny because some of the ghost cities that they were talking about earlier, probably 10 years ago, are now fully filled and are the technical hubs. They're the manufacturing hubs. They're the tourism destinations. So just needless bearishness and doom and glooming that's been going on forever. And I'm not going to say that I'm right and the Chinese property market is in good hands or that it's going to grow. I'm just saying, just because the headline is out there today doesn't mean it hasn't been out there forever. People trying to predict collapse. Everyone wants to be the next Michael Burry. Everyone wants to get movies made upon them because they predicted the collapse. It's nothing new. It's human nature. So please, let's stop sharing headlines that don't mean anything because they've been pumping the same thing year after year after year. Okay, enough of that. So into the companies. The first one we'll talk about ROK Resources, a kind of a newer addition to my portfolio, something that I wasn't really a fan of when they did their acquisition, and they gave out all these warrants, and the stock price was already a little bit inflated from the placement, so it wasn't really looking like a great risk reward. But where we are today, there's a few changes that have happened. The wells are coming on strong. The stock price has arguably lagged its peers. The impact of the warrants is a little better understood. I've had not recently, but I did talk to management earlier, and I think I will talk to them again. I'll kind of figure out what the latest plan is here. But the company itself, I think these sorts of companies are getting more and more interesting because the macro itself has become clearer. I think when the placement happened in February, March, there was still significant concern around OPEC spare capacity, world oil demand, how the COVID Omicron was happening, the shale play, kind of what's going on there. So I honestly think on a global economic situation, the path for oil has just become more clear. So the growth companies have become a little more interesting. Despite a lot of people wanting the Eric Nuttall, cash return to shareholders model, if you look at the companies that have done the best year to date, they neither had dividends nor any share buybacks so far this year. So the model may work going forward, but it's all kind of going to depend on your subjective risk reward you're looking for out of the cycle. So companies like this, to me, have become more interesting because if I can get a 20 to 40% growth instead of paying that out in dividends or share buybacks, and I allocate a part of my portfolio to these sorts of companies, I'm almost giving myself a opportunity for alpha if the cycle continues as is. And ROK is especially interesting because they've hedged out a lot of their barrels at $95 plus. So it's a high floor, high ceiling bet. Pretty interesting. So we'll go through our valuation model. I'm not going to run through everything. For those that are joining us for the first time, I have about 20 videos of the previous sessions where I explain exactly what I'm doing and where I got each individual box and what it means. So please have a look at those ones, the previous sessions, for more information. But I'll just kind of run through them quick. So ROK did a pretty major acquisition in Q1, Q2. They haven't released their Q2 results, so we don't have the latest data, but we do have a latest news release that they just put out last Monday, which kind of gave us a pretty good understanding as to where the company is. So Saskatchewan operations update, they say current production is 3,300 BOEs, 72% oil and NGL. So we put the production in 3,300 BOEs, 72% liquids, and I don't have a breakdown on it, but based on the acquisition and their pre-existing production, pre-acquisition, I've kind of said the light oil is about 2,100 barrels and the NGLs is 231, the rest is gas. Shares outstanding. So if we just go right here, we see shares outstanding, 195 million shares. Basically pump that in there. The share price is auto-calculated based on Google Finance. And the current debt. So we don't have a latest current debt info, but basically what I've done, I've taken their year-end debt number, 26 million, and I've backdated it 6 months. So they said they're going to make roughly, call it 40 to 50 million of free cash flow for the year. So for 6 months, roughly 25 million of that is going to debt. So 26 plus 25, call it roughly $50 million is their current debt. So market cap plus debt equals your EV. enterprise value, your total value of the company. Again, debt to EV ratios. I've discussed this in detail in the previous presentations, what it means and kind of where to position yourself depending on your investment style. They don't have a dividend, so zero. The adjusted funds flow, again, we don't have Q2 results for ROK, so I'm going to again kind of back calculate it. And the way I'm going to do that is I'm just going to take the strip pricing somewhere between $80 and $100 WTI. They're saying they're going to generate, call it 60 million, maybe a little bit higher, because this doesn't account for the fact that the acquisition wasn't on January 1st of the year. So call it 60 to 65 million of adjusted funds flow, debt adjusted cash flow, same thing. We got to be careful with the terminology a bit, but they basically mean the same thing. So 65 million, I divided by 4, the adjusted funds flow is going to be 17 million for the quarter. Free cash flow, basically we just subtract capex. Capex is 20 million for the year, 5 million a quarter. So 17 minus 5, 12. Again, this is last quarter, not for the year, but for the quarter. I put in the last quarter WTI pricing, strip pricing, WCS and NGLs, not 100% exact, but the strip pricing you can calculate yourself from cmegroup.com, or you can go to RBC Richardson Bar and get the latest number. So that's in there. NGLs, a little bit harder, but NGL is not a big part of their production anyway, so give it your best estimate. Exchange rate, gas price, everything goes in there, and we get our numbers. So this is the exact same as literally the last 15 to 20 sessions. So, the interesting part about this company is the torque, the built-in torque that you have in here. So in an $80 oil price environment, about a 15% free cash flow yield, which gives us a fair share price of 42 cents. So only about a 40% upside. And you're kind of thinking, well, is it really worth it to go into the juniors if I'm only getting a 40% upside? I'm getting a 40% upside in the white caps and the mags and the surges of the world, much bigger, more known companies. But where it really changes is if you believe in a $100 oil price environment going forward, the fair share price on an 8 times free cash flow model, which is what this is. And again, if you want more clarification as to what I'm explaining here or doing, please have a look at the previous sessions. I go into detail why I'm using 8 times free cash flow, the 4 times adjusted funds flow model, et cetera, et cetera. So at $100 price environment, it's now trading at a 34% free cash flow yield. And because this company is so heavily debted, there's almost 50% debt to equity. The fair share price ends up at $1.27. So you're looking at call it a 4.2x on current share price. And that's where these junior companies start to get really, really interesting. The floor on the price is pretty high already, where it's kind of trading at where it would in a 60 to or 75 to $80 oil price environment, which would be in my models even below the lowest that I run. And on the upper end, you're getting skewed risk reward potential. So, at $80 price, I get a 40% upside. At $100 price, I get a 4x upside. And at $120 WTI, it's at a 53% free cash flow yield, which gives me about a 7x from current pricing. And this is assuming they make no good drills on an engineering/geological perspective. If they come out and they're like a Baytex and they hit something in the Clearwater, ROK is not in the Clearwater, but in the Cardium, if they hit something in the Southeast Saskatchewan area, a really solid Frobisher well that instead of 200 barrels a day flows at 400 barrels a day or 500 barrels a day, now all of a sudden the company goes from making 2,400 liquids a day to 27, 28, 3,000 liquids a day. And there's a secondary hidden upside torque built in if they can hit good drills. And the nice thing about companies like ROK and even other companies is that they have the time. Unlike a Crescent Point who's drilling hundreds of wells a year, ROK is only drilling 7 to 10 Frobisher wells a year. So their engineering team has time to really focus on the geology, really focus on the drilling plan, focus on the engineering, focus on what kind of pump they're going to put in these wells, and give you that extra care and love that these wells need, and can make the difference between a 200 barrel a day well and a 250 barrel a day well, which over 10 wells gives you 2 or 3 free wells every year. And not only is that great, the other thing is you have an opportunity to talk to management of these companies. We had ROK management on for Twitter Spaces in March, I believe. They are relatively accessible, unlike the VPs in the big companies. I can go and talk to the VP engineering at ROK or the COO or the CEO literally anytime and kind of try and figure out where their head's at. What are they spending their time on? Are they really focusing on the Frobisher wells? Do they see something in the geology that may be indicative of something coming up? And then what kind of wells are they drilling? So it's a very personalized approach that I take with these companies if I'm going to invest in them, and really try and understand, are management capable? Are they experienced? Have they done this before? And do they care? The fourth point is probably one of the biggest things. A lot of junior companies are run just like, people are chilling out all the time. And that's because they know they're going to make money either way. But I want companies where the management is driven. They want to hit it out of the park. They want to hit grand slams. They're really focused and they want to make tons of money, because I, as an investor, want to make tons of money. So the accessibility of management in these companies gives me that as well. But enough on that. So that's kind of the upside here. They do have some hedges put in. I haven't put them in here because I want to look at the company on a strictly unhedged basis. The reason for that is I think there's going to become opportunities in the future where companies can monetize their hedge book. So if you see drawdowns in pricing to some sort of level, you've already seen this in some of the US plays where companies are monetizing their hedge book, as in they're actually taking the money on these contracts, paying down the debt with that money, and then banking on a higher oil price going forward. So are we going to see more and more of this with companies like ROK, for example? They've got their second half 2022 hedges at $105 a barrel. Today we're at 91, 92. You have quite a bit of money sitting there that could potentially be monetized, and then you pay down the debt on it right away, and then you bank on a higher oil price. So depending on management's view on macro and the difference between the hedge price and the current price, you might see this come into play. I'm not saying it's going to happen. You might see it. Okay, so the hedges is done. We add in a little bit of production growth because if we go back to the news release, we see they're looking at a 3,500 BOE exit rate. So looking 12 months out, it could be a little bit even higher than that, but we're going to go conservative. We're going to put in roughly 200 barrels or BOEs growth, 3,300 plus 200, we get to our 3,500. Oh, sorry, 3,500. And I'm going to put a growth net back in of $75 a barrel. They are drilling a lot of oil-focused plays, so feel free to put whatever number you want in there as to the net back of each barrel going forward. And we end up with our final fair share prices. So if you believe in a $100 oil price environment, we're now looking at, with the growth baked in, we're now looking at roughly 5x from current pricing, and that's at a $100 oil price environment. If we try and dare to dream, as we say, things can get pretty torqued up in in quite a hurry. And I guess one point I do want to make on this is the debt itself is, if they're going to generate, call it 40 million of free cash flow in the next year, and we take it out of the debt number, we just, we look a year out, we change our debt. Basically what happens is the floor of the company just keeps moving up and up and up. So not only do you have this upside torque built in, as they pay down the debt, which is such a big part of their enterprise value right now, the minimum floor level of the company just keeps moving up. And you see the free cash flow yields go up pretty substantially just by paying down debt. A lot of the big companies, you don't get this sort of leverage built in. So potentially, if you're that kind of investor, could be something that's interesting to you if you're willing to look that far out and you believe in the higher for longer kind of cycle here, especially as the SPR releases end here, October, November time. We kind of enter a different era in oil supply demand. Okay, and while I'm on that, don't forget, it's not just the US that's releasing SPR barrels. There's other barrels, about 50 to 60 million, I want to say, worldwide that are also being released. And nobody's really talking about them, but they do make an impact on a global oil supply demand in a commercial inventory standpoint, which are also ending in October, November. Okay, so 2022 capital program, roughly $20 million. We end up with our free cash flow yields, 30% today, 42% next year. And the interesting part here is if we look a year out, we pay back that debt again. Now we get to 47% and almost 100% free cash flow yield. If you're looking at it from a year out and then looking next 12 months, you're looking at 100% free cash flow yield at strip pricing, which is $88 a barrel. So if you believe in a strip pricing, even a little bit higher than that, you're getting more than 100% free cash flow yield a year out. But again, the reason I run simulations and models like this is because in these sorts of junior companies, it makes such a heightened impact that it's almost worth looking into. Okay, if they pay back the debt at this rate for the next year, where do I end up a year out? And you'll find it's like a compounding torque effect, where it's almost like an exponential return that you get going forward. But we'll kind of play that as we go along. I'm hoping to do updates on these companies kind of every year. Try and line up my seminars so that they line up exactly a year and kind of see how the companies do going into 2023. So a couple things on management here. They are experienced. They've run 4 companies in the past that they've sold, and the aggregate return on them was about a 3x from the initial private placement. And if we look at the companies, 2 of them were in possibly the worst cycles you could kind of raise money in. April 2013, we had mid 2014, basically the bottom fell out of oil. And then July 2018, nothing really happened from July 2018 onwards. The oil price was basically at a point where you weren't really making any money, and there was very little interest in the sector. And on an aggregate basis, they still ended up 3xing investor returns. The private placement, I believe, for ROK was at 18 cents, 18 or 20 cents. So a 3x from that puts you at roughly a double of where we are today in an oil price environment that is much, much stronger and conducive now to companies like this. The capitalization, it's the warrants that really we need to focus on. So I do say that we have this upside going forward, but we have significant warrant overhang. And really, these first 3 warrants aren't that big a deal. And they expire right away as well. Like this one, this one's already expired. So these might have been converted already, but it's these March 7th, 2025 warrants. There's about 117 million shares that can be created at 25 cents. So they are going to be an overhang on the stock. Why? Because you can buy the warrant and you can basically convert them at that 25-cent mark, really whenever you want, all the way up till 2025. You are going to find that if the stock can break out of its kind of warrant area, like this 25-cent area, the warrants become less and less attractive because they just have less leverage built in. You'll find less people trying to trade them. They'll just hold them as an option in a way, which does reduce the overhang on them, but they are there. So what I would like clarity from, if I was talking to management here next time, is, let's say the stock is at 40 cents in a couple of months, and they have some liquidity come in, and they think the company is going to do really, really well. It could make sense to take on a little bit of debt or push back a payment and kind of just buy these warrants back on the open market, because you're going to reduce the warrant overhang on the market. You're going to make it a better share structure going forward. And it's going to be much more accretive almost to buy these if your share price is quite undervalued than to go and buy your shares itself, or to pay dividends, or to go and make other acquisitions. So potentially something that could be down the road. I think I would like them to buy a block of this before they go too far in the money. It's going to help the entire kind of company. All the shareholders are going to be happier. But if they're looking to make more acquisitions, they're not going to do that. So there's a lot going on with the company, and it's going to affect the upside a lot going forward. Being in contact with management regularly in a company like this, I think is going to be quite important. Not to say that they're going to tell you exactly what they're doing or that there's an acquisition on the way, but you kind of get an idea as to what they're thinking, what they're seeing in the markets, what they're perceiving out there. The insider ownership is pretty good, so I do like the fact that they're quite invested in the company itself. I also like that they're running realistic sensitivities. So they show you all the way from $60 a barrel to 140. So, you could basically take this, extrapolate any number in there, and kind of run your own models yourself. I hate when companies give you 45, 60, 75, and 80. It doesn't let you properly extrapolate the upside without making a bunch of guesses and then going into the hedging situation and having to run all sorts of hedges through your model. This is really, really nice. It includes hedges. They're telling you how much debt they're going to pay down, and the rest is free cash flow. We don't really know what the free cash flow is going to be used for, but we'll find out. Okay, so a couple of questions here. Did you account for the warrants in the FCF yield? So no, I have not accounted for them in the FCF yield. And there's kind of two reasons for that. One, they're all the way out till 2025. So to take them into account right now is kind of misleading to the upside that's there. Secondly, like I said, if the company does choose to buy back the warrants, there's kind of a change there. And C, when the warrants are executed, the company is getting 25 cents in straight cash per new share as well. So if they exercise the 134 million warrants, the company is going to end up getting like $30 million of cash, which is going to be then applied to the net debt and the interest going forward. So it just gets way too complicated because we don't know in which order these things are going to happen. So I just leave them out and basically put them into the model as the warrant price changes, as the stock price changes, as the macro changes. You can run different models. You can say, okay, what if this many warrants were exercised? What if the entire thing was exercised? What if they bought back the entire thing today? Like these warrants today would be trading at roughly I haven't checked the price, but probably around 15 to 20 cents. So they could buy out the entire warrant block back for only, call it $20 million roughly, which is the free cash flow, the extra free cash flow they could be making this year. Is there an argument to do it? Yeah, I think so. It definitely helps your stock price. Yeah, bid is 14.5 cents right there. So Dirk, yeah, people are playing all these things differently. So for me to make a decision for you and say this is how the warrants are going to work, I think would be wrong. So I left it as is, and people can run their own models on the warrants, which I think is, you have to run some sort of model on the warrants. You can't just leave them because they're not going to expire worthless. These 2025 ones especially are not going to expire worthless. So they have to be taken into account in one way or the other. Hedging. So Q2, they had $113 hedging. Q3, they've got hedging at roughly $102 a barrel. So this hedging right now is roughly $10 a barrel in the money. So, pretty good hedging even going into the future, because I bet a lot of this stuff is still in the money with the way the curve is backwardated. Natural gas, not bad. So, they hedged at the absolute top-ish in, call it February, March. So pretty significant hedges, but they're dropping off. The numbers aren't too bad. And any extra production is unhedged. So kind of a win-win in a way. And I think some investors who actually care to look at companies like this will be happy, because they're so concerned about recession and oil price dropping and demand destruction. Well, here's a company that's got 75% of PDP hedged at $80+ a barrel into 2024. Sounds like a pretty safe risk reward bet here to be taking, with significant upside if things work out. Again, not investment advice. This is the way that I look at this company. In a macro bullish cycle, in a rising commodity price environment, high floor, high ceiling bets are pretty hard to find. And I think there's one here. So this is their Southeast Saskatchewan acreage. I like to see open green blocks where you have open areas. You can go out and drill. You can do some wildcatting in a way, try and extend out fields, try and find little pools. You're also next to competitor activity, as you see here. This area, kind of these areas. I also like to see companies that have blocks with only vertical drilling on it, the dots here, because this means there's already oil there. There's significant test wells. There's significant well logging. There's significant seismic in the area, probably. And you have so much data to go off of to now start drilling horizontal wells. And it's especially important in the Southeast Saskatchewan area because the net pay of the zones is not very thick. It's somewhere between 5 to 10 meters, as low as 3 meters thick zones. So imagine you've got a 3 meter thick river. You're trying to drill into it vertically. You only access a certain part of the reservoir. Whereas if you drill into them horizontally into the river, you're getting way more reservoir rock than doing the same thing in a thicker zone. So there's a lot of oil, stranded oil that's left in place. So, watch for increased horizontal drilling in these areas. And I also like Southeast Saskatchewan because it's a place to be for CO2 flooding. And not only does CO2 flooding increase your production and better reserves, better life, you also get carbon credits on it. Maybe not right now for strictly EOR, but as things go on, it's just going to be more and more focus on CO2, decarbonization. You're getting CO2 credits for building new injection sites, and the price of carbon itself is going up. So it's worth having exposure to Southeast Saskatchewan just for that reason. And I've got exposure through Surge, a little bit through Whitecap, and some of the other names. But this is almost like a more focused way of doing it. They also have a 2% stake in the Weyburn field, the world famous, world-class Weyburn CO2 flood that Whitecap's running. It can never hurt to have exposure to that field. That is a best of the best example as to how CO2 flooding works. Cardium and Montney. So this pool is not that great. It's kind of just status quo, middle of the pack, Cardium pool. There's not really much going on. They are trying to drill some Cardium horizontals, looks like, outside the main trend. So be interesting to see how these wells work out. I do like the Montney drill here. This is I have a secondary map here later, but it's very close to Athabasca's Placid Montney. And I was following Athabasca's Montney and Duvernay for quite a while, since 2016, looking at the well results, see how they're coming out. And this is kind of a cheaper-ish part of the Montney to drill. You can get condensate wells, you can get gas Montney, you can get oil Montney. It's kind of very variable. And I'm kind of excited to see how they do, because there's not much Montney activity in this exact area besides Paramount. And Paramount's been hitting some really good gas wells, like in the range of 700, 800, 900 BOEs a day of straight gas. And if they can hit something with a little bit of condensate on it, I think these wells are going to be pretty good for a junior company of this size, especially if gas prices can stay. I know AECO is down quite a bit, but if gas prices can stay a little bit higher, I think this could be a pretty decent zone. So watch for this in 2023, a little bit further out. I like the fact how clear they've made their news releases. They said they would release a Southeast Sask update in August 8th, it's here. Not like some of the other companies where it's August 31st, it's September 15th, and I'm calling management like, hey, what's going on? I'm getting messages, hey, did you hear any update as to what's happening? It's just not a good look for these junior companies to be delayed in their news releases, to not be in touch with shareholders. And I'm very aware, I'm talking about companies in my portfolio that are behaving that way as well. So for ROK Resources to say, look, August, we're going to tell you, not the first, but the second week of August, the first Monday, second Monday, it's there. The update is there for you, and you know what's going on. Love it. I'm going to get an update on KBOB in October. I'm going to get a budget in November. I'm going to get a drill program update in January. Great. Great to see this sort of transparency. People have PTSD from junior Canadian oil and gas companies. It's in their best interest to alleviate that concern. Put out regular news releases. Have management be accessible and out there. ROK is doing a great job. And so are some of the other companies that are a little bit bigger in size as well. So I talked about the Frobisher wells. Again, they've hit a Frobisher well that is more than 300 BOEs per day, exceeding type curve by 53%. You might say big deal, but that's an extra 100 barrels per day. An extra 100 barrels per day at lower royalty rates in the Frobisher, cheap operating cost, Southeast Saskatchewan, lots of oil field activity anyway in the area. So extra 100 barrels per day, $80 net back, call it. That's $250,000 a month. And again, may not sound like a big deal, but for a company that's only worth 90 million or so, if I can get an extra $500,000 a year from few drills here and there, and I can use that to pay back down debt, that's a pretty significant deal. That could be the difference between a 3% extra free cash flow yield in just a year, and I'm getting it for free. I literally did nothing except rely on the company to drill good wells. So, people who have watched my previous presentations know I love the Frobisher wells. this well, I bet you pays back in 6 weeks or less, and probably pays back twice in 4 months, 4 to 5 months ish. So you don't see these kind of returns anywhere else except maybe the Baytex Clearwater. Nothing else is really putting out this sort of return and net back out there right now. So very happy with these Frobishers. I think they got a pretty good deals. Remember that ROK doesn't just have Frobisher from the Federated Co-op deal. They have Frobishers from their previous deals they were making in 2018, 2019, I believe, a few years before anyway. So they were buying assets in the depth of the COVID crisis for basically pennies on the dollar, which are now paying good dividends. Couple of the other fields, I just like snooping around on Petro Ninja, looking at stuff that's out there, and few sections here and there, like with old vertical drilling, all suspended wells. So what does this tell me? That tells me this asset, something happened either in 2014 or 2008 or 1999, where these wells were just shut in for good, but they never abandoned them. They left them in a suspended state. At $100 oil price environment going forward, with a junior company that can really focus on these assets, who says they can't come in here and fire up these water injectors, these 3 water injectors, these suspended wells, maybe try some recompletes, maybe try acid job, do some extra perfs, maybe drill an infill horizontal in here, and it becomes a nice low decline, 100, 2, 3, 400 barrel a day operation that just declines at really solid netbacks. I really enjoy seeing this because the market doesn't care. The market doesn't even know about these things. But 1 year, 2 year into $100 oil price environment, people are going to start looking within their own portfolios at opportunities like this. And guess what? A lot of people, not only do they not see this as a production opportunity, they see this as ARO, as asset retirement obligation. So they see a positive as a complete negative. I'll take those bets all day long. Here's another one in Gull Lake. So for those that watched my Vital Oil junior play information thing a couple months ago, Vital Oil is in Gull Lake right here. They got some pretty decent drilling plans coming up. And look at all the open acreage that ROK has here. They got tons of acreage here that's just wide open with no drilling. They got a bunch of old stuff and some horizontals. So maybe they'll let Vital drill, wait for a little bit, get their production information, get some well logs, try to understand what's going on, and then start capitalizing this asset. Who's to say there's no, I think Gull Lake is Shaunavon zone. Who's to say there's no Shaunavon potential in this completely open area here? Maybe it just wasn't cost competitive at $60, $70, $80 oil. At $100 oil, if you have a facility in the area, if you have kind of knowledge of what's going on, you already own the land, you're not paying anything for acreage, could get pretty interesting. Okay, so there's some questions here I'll just hit before I continue. Gas prices in winter may be double digits. Yeah, Michael, you're completely bang on. The gas prices are something that are very traded on the margin as to what's happening. If you have a cold winter, you get half a BCF a day of freeze-offs in Northeast BC. You get extra demand. You have maybe a couple of coal plants that are still transitioning to natural gas in Alberta. There's people moving into Alberta. Yeah, and if the US starts wanting more and more of that gas coming in, you could see double digits for sure. Will they be a beneficiary of heavy WTI spread narrowing? No. ROK is not really going to benefit. Like the light spread has also blown out a little bit, but not a huge significant concern. I don't think I would invest in this based on that thesis. There's other companies that are going to benefit more. But yeah, great question. Yeah, so thanks, Dirk. If you want to talk about know more about the warrants, I do have an intro to options seminar on my website and on YouTube. So it explains kind of more about warrants, options, etc. And does anyone have a good source for Canadian gas storage? Yeah, so Mike, if you go to ROK Energy Institute, just search that up. They have a weekly newsletter they put out that shows you the latest Canadian natural gas storage every week. It's a completely free source and great data in there on not just storage, but on production as well. So you can track that week by week, and it doesn't get any better than free data that's really good and every week. Okay, so to continue on, this is the well status of every single well in Canada by status. So there's about 45% are abandoned, about 35% are active, and about 10% are suspended. So, okay. When I look at ROK in particular, 25% of the wells are suspended. And again, people look at this and they say, asset retirement obligation, hands off, I don't want to touch it. I see opportunity. I see wells that were suspended but have not been abandoned for whatever reason. And suspended, you go in there, you do a workover, you do a refrac, you do an acid job, which was not capital efficient at $70 or $80 oil. At $90, $100, $110 oil, a lot of things become capital efficient. And if I already have wells that I don't have to drill, I don't have to complete, I don't have to buy casing, I don't have to buy wellheads, I don't have to buy separators, it's already there. It makes the capital efficiency that much better. So I'm actually focusing a lot now on companies that have a high suspended well count and going into PetroNinja, looking at them and seeing what kind of suspended wells were they, when were they shut off, and what kind of production were they making when they were shut off. Was there a water flooding issue? Was there a regulatory issue? Was there a geologic issue? Or was it just strict capital efficiency problem? And trying to build out my thesis on some of these names and kind of see where the upside really is on them. So this is the latest well that ROK just got a well license out for on August 11th. It's right here, 2 of 20. And again, what I've been doing, I look at the new licenses and I look at competitor activity in the area. What kind of well can I expect this well to be? And, you know, like ROK is only pulling 10 to 12 licenses a quarter. It doesn't take that much time to go in, look where the license is, look at the competitor wells and figure out, is this well going to be type curve? Is this well going to be a type curve? Or is this well a kind of a zone extension / semi wildcat well where we may not hit any oil? And you can get a good idea of what your production is going to be, and are you going to beat production numbers? Is management sandbagging? Just by doing these simple exercises. And you know, this company, I found lots of good zones that they're drilling. So we look at this area right here. This well up here is a half decent Frobisher well that ROK owns. And again, this is where they're drilling right here. This is a Saturn Oil well that was completely water. So keep in mind, the Frobisher is tiny little pools all over the place. It's not a contiguous zone. It's small pools all over the place. If you can drill in the center of the pool, you get 400 barrel a day wells for $1 million. The absolute best wells in North America, no comparison. If you can drill on the edges of the pool, you get 100, 200 barrel a day wells. Still 7 to 10 week payouts are really solid. If you just miss the pool, you get completely water. You get 500-600 barrels a day of water. So I'm getting lots of comments here. Okay. So let me just finish my thought and I'll get to these comments here. So you're saying, okay, so there's a marginal Frobisher well to the north there's a completely water well to the south. Why am I so excited for this well right here in the center? Because these wells right here, these two, and these 5 or 6 wells here, are drilled by a company called ROK Resources. It's a private company, roughly 1,000 barrels a day, maybe a little bit more now because they've been quite active. And these are good Frobisher wells. These two, I believe these were Nova as well. And these 5 or 6 wells are really good wells, Frobishers. And so what's the big deal? Is that Nova Resources is run by a pretty young guy. All they do is Frobishers, and they hit every damn Frobisher well is a success. Why is that? Because their main geologist is somebody who's been drilling these Frobishers for 40 or 50 or 60 years. Like, it's somebody who is one of a kind in Frobishers. They went out and they bought a bunch of Frobisher acreage in 2020, 2021, every lease sale they could find where they had identified these pools from this geologist slash co-owner of the company. I've spoken with Nova Resources management, call it, and they know the Frobisher. There's nobody in this area, not even Surge, that knows the Frobisher like Nova. So when I see them drilling good wells here, and these are new drills, recent drills, and I see ROK right smack dab in the center of it, I'm thinking the pool is going something like this, you know, in sort of a oval shape, and ROK just happens to have the, in my opinion, the center of it. Now, is it going to pan out exactly how I think it is? Maybe, maybe not, but I've got pretty good confidence that I'm pretty excited to see the results of this August 11th license and see how it pans out. So, okay. And again, the reason it's so important with these companies is because if this well is really good and I have 200 to 300 barrels a day of extra production, that's a 10% beat on production right there from one well. In a Surge or a Crescent Point, you know, in a Crescent Point, no difference. In a Surge, it still makes a pretty significant difference. But on a company that's only producing 2,200 barrels a day of liquids, it's a big, big deal. Okay, so is suspended the same as DUCs? No. So suspended wells are wells that used to produce in the past. They've been suspended, as in they don't produce. And I think the minimum requirement is you must run the well once every year or once every 3 years. It must show some production. So what a lot of companies do, what I used to do when I used to operate wells, was I would get orders from Calgary that, hey, can you go out there and produce this well for 3 days, produce it for a week, produce it for 12 hours, you know, whatever. Just show the AER that this well is still producing. It's not just a wellhead sitting in the middle of nowhere. It's got piping, it's got tanks, it's got proper production, ways to bring the well on production in a quick time frame. So those are suspended wells. I don't know if Saskatchewan has the same rules, but the well has not been abandoned, aka it can be brought back on production pretty cheaply compared to drilling a new well. All right, here, so Dirk's already got this here. So yeah, so it must pass through a inactive phase, and yeah, so a great point there. So I see Enerplus is getting a $2 per barrel premium in Bakken. I haven't been tracking the premiums too much there, Robert, but I do assume that the Southeast Saskatchewan stuff is trading pretty good pricing. Not the $5 to $7 diffs that I saw pre-COVID. I think they're getting pretty decent pricing, and they might even be getting higher than WTI as long as there's enough pipeline space, which it all kind of depends on where the Enbridge system is in terms of its apportionment. So definitely watching that closely. Joe Beats on Twitter is keeping me informed on the latest on that, so appreciate your help. Yeah, Dirk says this must be what insider trading feels like. Yeah, except it's public data. You can go in there and see what's going on. You can figure out who's the management of these companies in the area, private companies. You can figure out how capable they are, what kind of lands they own, what kind of wells they drill, and you can go in there and make assumptions about kind of what's going on, educated guessing. And this sort of data was not available in 2014, not this easily visualized. So when you see companies like i3 going out there and drilling monster after monster well in random locations, this is why. They have an entire team that just goes in here, looks for land, looks for suspended wells, looks for tiny little pools that got missed, reads well logs all day, and figures out where they should be bidding on small little sections and pools everywhere, and they go out and drill banger after banger. They're doing exactly what I'm doing, but they actually own the wells. I just invest in the companies. So it's such a great opportunity. Like, I am absolutely amazed at the data that's out there. You could easily go in and start an oil company if you cared to take the time to just look through well after well after well after well, and just find zones that were bypassed, find land near competitors that was kind of something happened. And I'll talk about an example like this in Saturn, I believe was the one, or maybe it was ROK. I'll just scroll down here and talk about it. But yeah, it's like a science in itself, and you can make tons of money doing it if you cared. How does this compare to PPR? So I don't really have a direct comparison. I think, they're both kind of doing the same thing. PPR is much more leveraged, so you have that upside, a lot more upside on the equity itself. But PPR also doesn't have any Cardium or Montney like big plays that can really juice up production. They got the good Glock wells, which are really decent. They got the Michichi BAM stuff, which is very similar to water flooding scheme, but not as much upside on the drilling potential with PPR, but a lot more potential on the workover side. So Placid Montney, like I mentioned, the Montney well that ROK is planning is right here. So, hang on, yeah, right here, right on the edge here. So you see this red line, that's the dry gas limit, as in above this, you have really good dry gas wells. This is the condensate limit. Anything above this, you have really good condensate wells. And look at kind of where ROK's well is. We don't really know where it is. Like, is it going to hit something? Is it going to be dry gas? Does this condensate line continue down and kind of maybe jump in here? We don't really know. We don't have good drilling in the area. Paramount's got some stuff here to the east, but not really good information here. So I'm hoping that, like I said, with my Frobishers, that ROK has gone in. They are nerding out over well logs in the area. They're talking to operators in the area, and they're going to drill a really good Montney, maybe, possibly with some condensate in it. That could open up some new sections here for them to kind of exploit in the future. And again, when I talk about companies having a geologic / engineering upside to them, this is what I mean. I think 1, 2, 3 Montney wells that come on really strong, using some sort of new technology or even existing technology, can kind of delineate quite a few well locations in the area, and it becomes again a compounding upside is what I'm kind of trying to call it. It's an upside that compounds in itself. And as you all know, if you compound something at 50% for even 3 or 4 times, you end up something way bigger than what you initially started off with. So a pretty cool little area. Not much for Montney development in this area, mostly Duvernay. This is where the Kaybob Duvernay is as well. Pretty much the exact same lands. So yeah, pretty curious to watch how this Montney drill is going to pan out. I hope it's not a dry hole because they are kind of right on the edge there, but we'll see. So, okay. Yeah, you're right. The analytic power and the data out there is just absolutely amazing. I mean, the success of a lot of companies was because of their analytics, their data analysis, their well logging, their seismic, that previously only the companies had access to. That company only had access to their own data. Now you as an investor or as a small junior company, you got access to thousands of times more data than people had back then. So yeah, you could really go and find some really good zones. Yeah, so Robert's saying, I really like the Cardium land ROK has in K-Bob. It's quite thick and juicy. I sent you an email with some images. Okay, I will definitely have a look there for sure. From what I saw, the well results are not anything game-changing. They're pretty good, and the Cardium is just a good zone to begin with. So if you have pretty decent results in a really good zone, it's a pretty good place to be either way. But not much for really like gang busting upside where you're going to hit some sort of massive zone. I don't really think so, but thanks, Robert. I will definitely have a look there. So this is kind of an interesting place. So here is a gas well that so the yellow is ROK land, the black is obviously the gas wells. Here's a gas well kind of on their land. It started production at roughly 5 MMCF per day, so about 1,000 BOEs of gas per day. It produced for quite a while, and it kind of leveled off around 250 MMCF per day, so call it 60, 70 BOEs per day of gas. Still a pretty good gas well compared to what you see for a lot of these vertical gas wells. And then 2008 happened, or no, 2018 happened, and the well just died. Early 2018, the well just died. And so what happened? What happened was, for those who are familiar with the industry, this area is the land that Perpetual Energy in 2016 sold to Sequoia. Sequoia bought the land. They operated for about 18 months. AECO gas price was absolute trash. Sequoia went bankrupt. But the issue was they filed a lawsuit onto Perpetual saying this transfer should have never happened. There was too much liability that got piled on along with the producing asset. So what they're saying is you transferred too much ARO for the amount of actual asset that you transferred to Sequoia. Okay, so two things here. One, that calculation was done with AECO pricing at $1.50 an MCF and huge liabilities on suspended wells that had to be abandoned at $4 to $6 an MCF. Those liabilities may no longer be liabilities to begin with, and the value of the producing asset is much bigger, quite a bit bigger. So the entire deal has kind of been switched on its head. They're still stuck in a lawsuit. It's been 4 years. Perpetual is still stuck in this lawsuit. Sequoia is still stuck in the lawsuit. There are some pretty damn good producing wells that got shut in for no reason other than the company went bankrupt that are on ROK land, 50-50 with Sequoia, or they're right next to them with nobody wanting ownership of this. Sounds like a really good opportunity for somebody that believes in higher gas pricing, natural gas pricing, that doesn't want to spend money on drilling, to take on all these shut-in gas wells for pennies on the dollar. I'm not going to claim here to be a judge or a lawyer that I understand how you would take control of these wells, but they're there. There are wells producing 60 to 70 BOEs of gas every day And at today's pricing, that's probably making you low decline, as you see, pretty low decline production. It's probably making you $500,000 a year, a well like this, net back after operating cost. Call it at $4, $5, $6 an MCF gas. And look how many of these kind of wells are in just this little area. And this doesn't even cover the entirety. It doesn't even cover a small portion of Sequoia's production that they took over from Perpetual. So I'll just leave that out there. I'm not saying ROK can do something about it, but yeah, when you throw something away that's a liability, and then you find out 5 years later, oh, this thing was actually a vintage lamp or a vintage vase from the Roman times, and it's actually worth 10 times what it was. Now all of a sudden it becomes a bidding war where people want it. So this one is really, really interesting. I'm quite curious to question management on it and just see how it plays out, because these are good wells. There's nothing wrong with these wells except the company went bankrupt and nobody wanted to look after them. That's the only thing wrong with these wells. So anyway, enough on that. I'll leave it there. Pretty cool little company, high floor, high ceiling. Again, in my opinion, this is not investment advice, but just the way I kind of see it. And I have these cool little upside on these workover project kind of plays and the Montney thing, which hopefully they end up capitalizing. So we'll move on to Saturn Oil. So Saturn Oil, very similar company to ROK. They're financed by the same kind of group there. Not financed, but the equity placements were with the same group. Very similar setup. Bought some assets, hedged 75% of PDP, locked in their kind of hedges, and on an acquiring mood. So before I get to that, ROK is a company where you may or may not see new acquisitions because their previous companies that management has run were not that big. By the time they sold it, only up to 1,000 to like 2,000 BOEs per day. So management might be quite comfortable with a 3,500 BOE per day company. Saturn Oil is an acquirer. It's an empire builder. It's the complete opposite. They want to just get bigger and bigger. They want to buy out any sort of acreage that's out there. And they have the backing of the Michael, of the Dell family, to kind of go out and just look for stuff that's accretive and cheap, whether it's in the Viking, whether it's Southeast Saskatchewan, whether it's Bakken, it doesn't really matter. They will go and acquire anything that's accretive, as far as my understanding. So they also have not released their Q2, but we have their kind of their latest information after they closed the acquisition. So 11,400 BOEs, 96% liquids. I just split it out as I thought most reasonable. Shares outstanding, share price, current debt. The valuation model uses the exact same inputs for every company. And if you want a copy of this, it's on my website as well. Scroll on the homepage, whitetundra.ca, scroll to the bottom under files. It's the first file, it's a Google Sheet now. You will have to create your own Google account and make a copy of it so that you can get this data table file along with it. So I'll put that out there. And while I'm on this, for anyone on the Twitter call that wants to join for the Zoom visuals, same thing, whitetundra.ca, scroll to the bottom under events. The Zoom link is on there, and you can join for the visuals. So same kind of thing. I've used a different last quarter's pricing for their WTI because the numbers that they're giving me are at $95 WTI. I can't really find it right now, but it's at $95 WTI for 2022. So I put that in there. I've once again had to go and backdate the adjusted funds flow. So if I go into, I might as well find it because make it clear. So I took their second half 2022 cash flow estimate, and then half of the 2023 cash flow estimate, added them up, divided by 4, and I get the quarterly adjusted funds flow. Then I took the capital program out of it, and then it ended up with a free cash flow number. I also modeled how much they lost on hedging. So basically, you look at Q2 hedging. This is Q3 and Q4 hedging, but I took Q2 hedging, took the difference between what Q2 was actually at, or no, I took the $95 last quarter WTI, subtracted the hedging, like the difference in the hedging. So they basically lost that much for every barrel, multiplied it by 91 days in Q2, and I got about $16 million of hedging impact, minus everything else is kind of the exact same. So where do we end up at $80 oil price, roughly 27% free cash flow yield? We get a fair share price of $9.31. So about a 3x from where we are currently, almost a 4x. At $100 price, we get about a 10x potential, $23 a share of fair share price using the 8 times FCF model. However, they got really bad hedging. Just with the way when they made the deal, when they put the hedges in. This also accounts for the new the new Viking hedging. So the prices have come up a bit, but still much lower than strip. So I put the hedges in. Pretty significant hedging loss. We see at $100 WTI, they're going to lose $84 million over the next year. So quite significant for a company where the enterprise value is only $360 million. So we put the hedges in, we put the production growth in. We see their kind of the growth information that they've given us right here. So this is the current production. We see a pretty aggressive growth cycle. By the end of next year, growth is going to be up roughly 3,000 BOEs per day, mostly oil. It's mostly oil. It's a 96% oil company. So we put the growth in with the net back in. And even with the hedging, this thing is setting up really strong. Like the upside at $80 oil is really good. The upside at $100 oil, even better, obviously about $16 a share, so about 7x at $100 oil. So setting up really nicely. We put the capital program in again. Really solid yields going forward. But again, there's kind of the problem of the warrants again. So very similar kind of way they've set this up. They've got 60 million shares, but 41 million warrants. Significant headwind to the company. People are playing games with the warrants where they're buying the warrants and shorting the stock. They're basically trading warrants, flipping warrants, and when the warrant price goes down, then the share price goes down. Like there's such an arbitrage built between these things. And not just that, they have 3 classes of warrants that are all publicly traded. They have a soil warrant, they have a soil warrant A and a soil warrant B. So different kinds of arbitrage games that people are playing. There's a lot of people in the warrants, but also the warrants expire next year. So you might see an exodus from the warrants. It's just a very complicated situation. So again, I'm not going to model it. I'm going to leave it to you to model it how you want. I run my own sensitivities based on whether the 2023 warrants end up in the money or not. And then I believe it's the 2026 or 2025 warrants, how they kind of pan out. Run all kinds of models. And if you're comfortable with the way it ends up, it becomes an investment. I currently have no position in Saturn Oil for other reasons. It has nothing to do with the warrants. It has to do with future acquisitions. I think Saturn continues to make acquisitions, which the market is not appreciating right now. And it also comes with further dilution, possibly. But if there's dilution at such a low price and they get really good assets that are going to be low decline into the future with workover potential, maybe that's something that could be worth looking at. even for myself in the future. So suspended wells, they got even a bigger chunk of their wells are in the suspended section, about 27 to 30%. So just future upside if you believe that these wells can be brought back onto production. Royalty rates, the Saskatchewan royalty rate is really, really conducive to investment. So compared to Alberta or BC, companies that are strictly Saskatchewan focused, like a Saturn Oil, are benefiting a lot from these lower royalties and possibly also lower operating costs. There's a lot of extra rigs and equipment and labor in the Southeast Saskatchewan market because it used to be a huge hub. There used to be massive drilling going on between Whitecap, Crescent Point, Vermilion. You know, some of the big boys were drilling a ton of wells in that area. So there is a bit of flex, I think, in that area, more than Grand Prairie, Montney, or Northeast BC, potentially. Helps the operating cost. So the Viking acquisition, July 2022, they just closed on it. It was about $250 million, $248 million, 4,000 BOEs, and it got them into a lower royalty area. It got them into lower operating cost areas. And as a company gets bigger, if you don't add on employees, you know, you get lower G&A cost, you might get lower interest cost, and you get lower operating cost. It's just more synergy. Saturn already had a Viking play, which was very low production. So they were suffering huge OpEx from kind of the transportation, the operating, the sales, the trucking, etc. They didn't have the scale to really get good rates on rigs and parts and labor, etc. Now they do. So now they get lower operating costs. So this is kind of interesting. So when the CPG package first came out for sale, this package that Saturn Oil acquired, I was asked for my thoughts from a news entity, let's call it, and the valuation I put on the package was $250 million, and it ended up selling for $248 million. So the reason I say that is not to pump my own tires. The reason I say that is because I think valuations are just getting closer and closer. Like this valuation that I did was at 75 WTI. And I think when February, March, April happened, the gap just got too large. The seller was looking for $110 pricing. The buyer wanted to pay $60 pricing. It just didn't mesh, and you didn't see M&A for quite a while. And now, June, July, August, we've seen WTI cool off a bit. We've seen the structure change on the back end. You see companies with more money, and you see deals happening at a $75 valuation. So the buyer came up a bit to the $75, $80 range. The sellers have come down to the $80 to $85 range, and you're seeing more deals happen. This is a $1 billion asset. Crescent Point spent $334 million when they bought this play in 2014. They've drilled about 450 wells since then at about $1.25 million each. So about $1 billion has been put into this asset to get it where it is. And they never really got the money out of it, because from 2014 to 2022, they didn't make that much free cash flow out of this asset. It was all basically spent on keeping production flat. And, you know, whether you want to say it means anything or not, it's a sunk cost thing. But the reality is $1 billion has been put into this asset that got bought for $248 million. So there's still significant potential in some of these older packages that people just don't want to buy. They don't want to deal with them. It's non-core. There's quite a bit of potential in these assets if you have a long enough time frame. If you're willing to produce these assets in a $80 to $100 oil price environment for, call it 10, 15, 20 years, water flooding, infill drilling, you can get a lot of money out, but over time. And you know, a lot of companies are just putting 10, 12, 15% discount rates on their cash flow, and they think, oh, this asset is worthless. Well, if you run the same asset at a 5 to 7% discount rate, it now becomes quite attractive. So the reason I'm not a fan of this asset overall is because you can't grow it. The yellow is the Saturn land, the black is the wells. So you can see almost everything in the core of the core is drilled up. You're not going to grow production here. You're going to just keep production flat for 10, 12, 15 years, make your cash flow, and kind of move on. So very limited upside, which is fine. I think for what the company wants to do with this asset, it's pretty stable. It makes sense. There's nothing wrong with it. It makes the company a lot stronger, as you see here. The pre-acquisition Saturn was just hampered by royalty, OPEX, and hedging. They were making very little money at the end of it. And the acquisition really strengthened up their pro forma company going forward. So, not a bad acquisition from a financial and company standpoint, from a reserve geologic standpoint, not the best, but hey, it'll produce at this rate for a long, long time. So it's fine. This extra land, I don't think is going to be in the Viking trend. So, maybe they end up drilling something, maybe they end up hitting some sort of Viking play here, which would be really good because then they can, prove these out a little bit more. But so far, nobody has had success. And the Viking is a pretty drilled up formation. It's people have spent a lot of money trying to find the other Vikings. So, we'll see how it goes. If they hit something, hey, gravy on top, absolutely exceptional. And if they don't, we get exactly the play that they've advertised. There's nothing sexy about it. There's nothing bad about it. It just is what it is. So talking a little bit about reserves and why I don't really think reserve life index means all that much. They say they have roughly 180 locations, 190 locations available, booked locations. But when you look at their production, what they're saying they're going to drill 3 wells a month for 10 years. That's 360 wells. So where are the rest of the wells? The rest of the wells just have not been booked yet, which means they don't show up in reserve reports. That's it. When a company says they got 8 years of 1P and 10 years of 2P, I would honestly just add 10 years to each, 5 to 10 years to each, depending on the assets they have. Some companies up to 20 years to each. They just have not delineated their land enough for these wells to show up in reserves. So, big deal. It's as they produce their wells, as they drill in the new areas, kind of the sides, the places they don't have infrastructure yet, it's going to keep adding to reserve. So what should you look at? You should look at reserve replacement. If a company produces X amount of barrels in 1 year, take out the acquisitions, did they replace that many reserves in the year? It's going to become more and more important going forward. Which companies are replacing 80% of reserve? Which companies are replacing 50%? Which companies are replacing 200%? The companies that are replacing less reserve than they produce are going to go out and make deals. They're going to go out and buy land. They're going to go and use your free cash flow on capital and land, not to dividends and buybacks. The companies that are doing reserve replacements of greater than 100% don't need to buy anything. They already have the land. They already have the assets. They already have the acreage. So watch for this. It's only usually reported at the end of the year. So 2023, we'll see. And also they don't break out acquisitions, which kind of sucks. But, make a good guess. You can make a good educated guess as to what's going on. Okay, the Crescent Point, Dodds Land area, what Saturn bought, the production profile on it. You can kind of see you have to spend money on it to keep it going. It's a pretty decently declining asset on the new drills. So they are talking about water flooding it more. So that might help the decline rate, but we'll see. It's they've got lots of vintage production, legacy production, and some new drills to top it off. Should keep it going for quite a while. Southeast Saskatchewan, lots of workovers here. They got lots of acreage, lots of Frobishers, lots of Mydales, Alida beds, Tilston beds, all kinds of formations. And they've been doing pretty good on their inactive wells return to production. So $2,300 per barrel per day of efficiency. If you run it even at a $60 netback, that's about a 6-week payout. So really, really solid workover potential here, and easy stuff, cookie cutter stuff. Like this is basically, it's guaranteed workover. There's no risk here. It's pump changes, it's pump jack changes, acid jobs, reperfs, tubing, hole in the tubing fixes, pretty simple cookie cutter stuff. So if they can keep doing this, awesome. It's going to add more low decline legacy production. They don't have to drill anything. They don't have to complete anything. And they don't need new steel, new casing, cheap stuff. Great. Awesome. And they're beating their own target capital efficiency rate by pretty significant margin, I'd say. And there's no ARO spending either. Despite all the talk and concern about ARO, they got $13 million from the They got $13 million from the site closure program. They've got $21 million deposited with the Saskatchewan government. I never took this $21 million into my enterprise value, but they actually gave them strict cash just for ARO spending. Now, with the Viking acquisitions, their liability ratios get better. They're also restarting old wells, so their liabilities are getting less from that standpoint. They might get some of this money back from the Saskatchewan government that can be used to pay back debt right then and there, and extra cash that's sitting out there. Okay, there's a couple questions. So how comfortable are you relying on the company reports of proved, probable, possible? They're pretty accurate. I would say for what the company has, they're pretty bang on, but they're inaccurate in the standpoint that they don't show what the company actually has. They don't get credit for reserves on land that they actually have not delineated. So, some people are telling me reserves are overstated. I would say reserves are very understated, like by a significant margin. If I was to look at the entire company and say where the oil is actually there and put a realistic strip pricing on it, the reserves that you're reading from 2021 year end are completely understated by a significant margin, both from a volume standpoint and from a dollar standpoint. But the market doesn't care. The market doesn't believe any of this anyway. So all of this will be redone on the 2022 reserve reports. And some companies you're going to be shocked as to what upside they really have on an NPV 10 basis, even on a 1P reserve going forward. So as far as I know, I haven't seen anything that has to do with 2C, like contingent reserves, maybe Vermilion's putting them out and IPCO, but I see what you mean. No, not everything is in the 2C reserve either. So yeah, I'll just leave it at that. Not everything shows up in 2C reserve. For example, Vermilion's Croatian and Hungarian acreage, there's no way they've accounted for that in 2C reserve. Nor a lot of the other kind of conventional assets with water flooding and CO2, they just are not getting credit for it. Any guess as to what Saturn could acquire next? Oh, loaded question. Yeah, I think Southeast Sask. Yeah, there's a lot of stuff out there for sale. I know Ridgeback's got the sale. Yeah, that's a pretty decent package. Crescent Point was selling their Stoughton stuff. That's a really good package for quite a while. You've got a bunch of mom and pop companies in the area, the pre-mentioned ROK Resources, Alden Oils, Adonai too, like all these little companies with 500-600 BOEs a day. Could be pretty interesting to buy them. And the reason a lot of these companies are selling is because they're becoming cash taxable. So Astra and Farsky sold to Surge because they were getting to the point where they were going to become cash taxable. So they just got acquired by a bigger entity that has a lot more tax pools than they need for a cheaper price than they would usually be willing to sell for, so that they can hold Surge shares and take advantage of this paying no taxes. Literally, it's a 23% change right there. So you might see more and more of this with some of these mom and pop companies as kind of time goes on. They would rather just be acquired for a cheaper price, and then they're non-cash taxable. So keep an eye out for that. But yeah, those would be the main packages. I think the Vikings got a ton for sale too, older stuff, but I'm sure they could make some deals in the Viking too. I don't think they leave Saskatchewan. The management team is Saskatchewan focused. They're Saskatchewan homebred boys, so they that's where home is, and they know the area, they know the people there, and they just know the acreage. But yeah, that's just me throwing out ideas. Production growth forecast, I talked about this before, so a pretty aggressive forecast here. We see this is the Oxbow asset that they got from Crescent Point earlier. So pretty decent wells. You see anywhere from 100 to 200 barrels a day. Pretty nice Frobisher, Mydale, Tilston, Manor wells. Lots of competitor activity in the area. This is another Oxbow area. So I think there's some wells here that went as far as 300 barrels a day. Yeah, like look at this one. So I know you can't really see it, but this Adonai Frobisher well, the IP 90 on it was 550 barrels a day. And like, look at where it is. It's outside of the main Frobisher pools. So they went out there, they identified some sort of pool, and they went and drilled it at 553 barrels a day. I bet you that thing is a 4-week payout. It paid out in 4 weeks or less, DCET cost. So all you need is companies like this, even Saturn or ROK, to just drill 1 or 2 or 3 of these, and all of a sudden you got all this bonus money flowing in, and you potentially delineate a new area. So it's not just the one well that's a bonus. You possibly can buy acreage in that area for free or cheap, or you already own it because it's a new area for the Frobisher. So yeah, that's cool. I never really noticed that before. Interesting. So another one on the Viking, you can kind of see how drilled up it is in the main areas. So, but again, they are drilling some semi-wildcat wells in Totnes, Plato, Prairiedale, Compeer, and you never know. These wells could pan out to be pretty decent Viking wells. Like, they don't need to be 500 barrel a day wells. Like, a good Viking well comes on at 100 barrels a day. So if they can even just hit that and have like 10 or 15 or 20 locations that come out of that, great, awesome. So, and they've got some acreage here on the sides where there hasn't really been that much drilling activity so far. Now the warrants. So as compared to the ROK warrants, you're making a big assumption on the Saturn Oil warrants, and that is on these 2023s. More than two-thirds of the warrants are expiring in less than a year, and their strike price is about 40% more than what the company is trading at. Not just that, some of the warrants may not be exercised because people bought them on the open market and paid a price for them. So these regular soil warrants, for example, they were trading as high as 4 cents a warrant. You need 20 of them to buy a share. So 4 times 20, 80 cents plus the strike price, $4. People still might exercise them at below $4 because they're kind of in the money. But if this thing is trading at 350, so call it a 60% gain from here in 10 to 12 months, a lot of these warrants are going to go down unexercised. They're just going to float away. So if you're willing to make a call on that and say, okay, these warrants are going to expire worthless, you've just taken out a lot of your headache and the headwind and these dilutive instruments going forward. And why is that important? Because your upside leverage then is way better. It's just way better going forward. If you have a company with 60 million shares versus 85 million shares, there's a lot more leverage built in to the company with less shares. It's a reason people do share buybacks. So I think we're going to see a lot of activity in these warrants going forward as people try and decide, are these going to expire worthless or are they going to expire in the money? Also, you could buy these warrants today. Let's say you buy the warrant at 20 cents. This soiled warrant B, you buy it at 20 or 30 cents, and it ends up that we end up in a $120 oil price environment. These warrants could become like 10 or 20x in a year. So this is one of the most leveraged options / warrant I think there is out there. And it's also contingent on them not making any more deals, because if they make more deals, it dilute it more. You might lose all your upside. I used to own these sold out warrants. I had quite a few of them, and I sold them all because they just started making too many deals. On the other hand, if they make another deal and it's strictly out of debt, like debt financing, now you have way more torque built into the equity. So now these warrants become worth even more. And you're going to see this constant fight between people's own thoughts, their own opinions, their own holdings, whether these warrants they're either going to expire worthless or they're going to be worth a lot. There's no real center ground, area that I see this ending up as. So, and it's a significant portion of the equity going forward. So definitely something to watch. I think if it becomes abundantly clear that these warrants are going to expire worthless, I think it makes a lot of sense. Even for me, I would look at Saturn Oil a lot more closely at buying the equity, the shares themselves. And you might see other people having the same idea. So again, not investment advice. I'm just sharing my opinion where I see this going. But kind of a very interesting play. It's almost like a lottery ticket scenario with these, and possibly people holding on to them for that exact reason. And the exact same situation as ROK. Management might come out and say, oh, we'll just buy these warrants while they're cheap, while they're trading for 2 cents for these warrants, and the warrant Bs are trading at 20 cents. We can buy the entire thing out for a few $1 million and just cancel them. And it's just that much better for their own shareholdings going forward. And I think if they end up doing that, that would be your sign that there's no more deals coming. There's no more M&A coming, because they're setting up for their own share price to do really well going forward. But again, I'm just brainstorming here. I'm throwing out ideas, stuff to think about, more than just, hey, what's the share price today? It's worth looking at these things, worth making some educated guesses as to where you see things going. The hedging, as I mentioned, a big negative. They've got hedging all the way into 2026. 2024 is at $63 a barrel. But the nice thing is, as their production grows, the hedging percentage gets less and less as a percentage of their total liquids production. So the prices suck, but the percentage is less and less. So, and the actual volumes actually end up less and less, because it was 75% of PDP that they had to hedge declining at a certain rate. Another negative, the private placements. They keep doing private placements, non-brokered, for select individuals. Conflict of interest issues here. It's not illegal, but it's just doesn't set off a right tone in my head. It's, you're doing small private placements for your friend, for your buddy, for your guy in Germany. It's not a huge amount, but poor governance. I think it's poor governance. To each their own. The fact of the matter is the person who bought this still bought it at 20% above today's pricing. So it's not like they got a sweetheart deal on it by any means. And you may think it doesn't matter. So, I'm going to kind of leave it up to you. So, yeah, and MT is correct. When the warrants are exercised, they're not just exercised for free. The company is going to get about $140 million if these warrants are all exercised. It's the same as creating new shares at $3.20 and then $4. So they could convert them all, get $140 million cash, pay down the debt right away. Then they don't have as restrictive of a hedging requirement, and maybe the company is just set up better moving forward. I'm kind of going to leave that up to you, how you want to model these warrants. There's a million ways you can do it, and you can almost run a sensitivity analysis on them. But I don't really want to share the way that I do it, because it's going to affect the way other people are seeing it. But feel free to play around with them. If you're an investor in this company, I think it's worth taking the time, play around with different warrant exercise scenarios for sure. So, okay, the new Frobisher wells that Saturn drilled, pretty good wells. They came on at 200 barrels a day. 5 months later, they're still producing over 100 barrels a day. So pretty decent Frobisher wells. They drilled a couple of these in January, came on in February. So decent wells. Water rates are going up as normal. Then they've got a couple of bad Frobisher wells. These wells are producing, this one came on at 50 barrels a day, down to 30. This one came on at 5 barrels a day. It's still only producing 10 barrels a day and 600 water per day. Not a good well. They missed zone possibly on it. And this is the risk you're taking with Frobisher wells, is when they come on really good. You get 6-week payouts, you get 10-week payouts. But when they miss big time. There's no middle ground. I mean, this well is only making 10 barrels a day, and it's never going to pay out. No matter what, oil could be $200 a barrel. It's never going to pay out. That's just a reality of drilling in the Frobisher. And I think it's worth watching, not just Saturn, but ROK and Vermilion and Whitecap and Surge. How are they doing the Frobisher? What's their success rate? And the reason I mention that is because it's not just one well that Saturn missed on. 3 of their newest drills all failed. 2 of them are producing, call it 20, 25 barrels a day. The one was less than 10, as I said. They're all producing more than 500 barrels of water per day. So possibly your disposal and operating cost with the water is more than you're making from the oil to begin with. So definitely a bit of a concern that 3 of the new drills ended up this way. But we'll see. We'll kind of watch. It's possible they kind of hit a bad area where they had bad seismic data, bad geological data, and just missed. Big deal. It's $3 million. For 3 wells, it's $3 million. It's not a big impact. Does it suck? Yeah. But we move on, we learn, and they move on to the next pool. But watch the Frobisher wells. I think they're worth tracking. So kind of re-optimization potential. I'm looking at restarting potential on these wells. So this is a normal water flooding well. A lot of Saskatchewan wells that are under water flood made 99% water and 1% oil. And it could be a little bit shocking to some people that you can still make a ton of money at these rates, but I I used to produce tons of wells that used to make 3 barrels a day and 300 or 400 water a day. So it's pretty normal in water flooding schemes. And there's wells like this that it was producing 12 barrels a day. It went down in 2014. I'm assuming this was a Crescent Point well, and just done. The well has done nothing since then. And the story is pretty clear. 2014 came, oil prices, went down, and Crescent Point went from a M&A / production growth company to a cost-cutting company. The well went down. It just never got the love it needed to be restarted since 2014. Saturn could come on now, and this well would probably start off at 20, 30, 40 barrels a day, pay out in 4 weeks, and then it produces 10 barrels a day for the rest of its life, free, completely free, until there's another problem, which you then again fix for cheap. And there's hundreds or thousands of these wells between Saskatchewan and Alberta that if you look at their data, they were producing more than 10 barrels a day. 2014 hit, no more money, don't spend money on anything. If the well goes down, keep it down. Now we have the money to spend on these wells to bring them back online. So don't take workovers and restarting wells as a joke. You can add pretty significant production for very cheap, low decline, high netback wells, and it just gives you that legacy free cash flow for very, very cheap. And if I had the time, I would go and look up every single well that these companies have and run kind of like a distribution on it and just see how many wells were shut off in 2014 and produced more than 10 barrels a day. Because I can almost guarantee you all these wells have nothing wrong with them. That's a significant problem. It's just a cookie cutter fix that just never got the right capital. And I would run that model. I would see how much production could they reasonably bring online, and kind of go from there. But it's, you're looking after thousands and thousands of wells, one by one by one. You're going through them. There's no really good software that does that for you quite yet. But hey, if somebody's using PetroNinja or Cartofact or any of these softwares and you know how to run something like that, please get a hold of me. I'm quite interested to kind of partner up on something like that. Here's again, Saturn has all these wells. And what's interesting here, so many suspended wells, no infill drilling and no horizontal drilling, and almost no water flooding support. Amazing, amazing. I see this and I just, money. Like this is straight up in $100 oil price environment. This is the sort of asset that if you give me money, this is the sort of asset I would be looking to buy. I can go in, I can infill drill, I can restart the vertical wells, I can start my water injection, I can get a good sense of the geology, drill some horizontals in these 3 to 5 meter thick zones, and basically just relax after that. So keep an eye out for areas like this that have not been horizontally drilled. Lots of potential sitting here. And from a worldwide supply demand perspective, not a big deal. But if Saturn can add 1,000 barrels a day of low decline production from here in 2 years, that's amazing. That 1,000 barrels a day is worth roughly $60 to $70 million. So that's $1 per share in this random field that I bet nobody's ever talked about when they talk about Saturn Oil. And these are the sorts of wells that are in this area. They produce at 50 to 60 to 70 barrels a day forever. And this one just got fired up again. This one, they added some water flooding support and they got really good results off it. 60 to 40, 50, 60, 70 barrel a day wells, take them all day long. I'll take them all day long. And I forgot to make a point here, but you see how much impact the water flooding makes. The well was starting to decline, and you added the water flooding support. You got this huge uptake right away, and then you kind of mitigated the decline over. This is like a 20-year period that we're looking at, that it really produced a lot of extra oil because of water flooding. So this is what Saturn says: starting water flood projects now, extensive rollout in 2023. Great, music to my ears. As the water flooding comes on, the wells are going to go from making 60 barrels a day to 200 barrels a day for a 1 or 2 year period. Oh, just amazing. Unhedged into a $100 oil price environment, unreal. The Watchdog platform, Saturn also has the Watchdog platform, which I used to run on my wells as well. It's basically a system that when you have a ton of wells out there, you don't want to go to them every day. You have pipeline pressure monitoring, pipeline temperature monitoring, leak detection, and cameras on every well that send you pictures 2 or 4 or 6 times a day. So it's a very good operating cost method. You don't need to pay guys. You don't need to be using up fuel and trucks to go all over the field every day. You pick your top 20 wells that need attention. You go there. Any well that has a blowout or a leak, it'll alarm you 24 hours a day. You can go there right away, fix it up. So it's better from an ESG standpoint. You don't have any leaks, less leaks. You catch them early. And it's just a better way of operating these huge old wells. So I'm glad Saturn is doing them, putting them on. They've got 1,000 sites already. A lot of them came from Crescent Point, but the fact that Saturn is open to keep doing them, keep installing them, really good. I think it's really good. It shows that management knows what they're doing in this standpoint, that how do we reduce operating costs on these old fields? So a couple of points here. 11,000 barrels a day is what their facilities are good for. So just the Oxbow asset. So it's producing roughly 6,000 right now. So there's no issues with them having to build new separators, build new pipelines, new tankage. Everything is already there. As you increase production from workovers, your per BOE operating cost gets lower. If you have a water separator, an inlet, a treater that goes from 70% full to 100% full, your cost didn't go up, but your per BOE cost is going to come down. Great. The way I kind of think about that is, if you have a company that has a $30 per BOE operating cost and you bring it down to 25, that's the same as WTI going from 95 to 100. It's the same thing, but it's often ignored with these high operating cost companies. People say, oh, these are shit coals, absolute garbage. They make no money at $80 oil, blah, blah, blah. They completely missed the point. They have completely missed the point. The point is, as the price gets higher, they have this exponential torque built in because they make so much more money per barrel as WTI goes higher. But also, as WTI goes higher, they do these projects and they reduce their per BOE operating cost, so their netback goes up even more exponentially from that. That's the kind of companies that are just absolutely amazing and make a ton of money. For those that know my portfolio, I've got a couple other ones in there. If you're wondering why Saturn isn't in there, I've got a couple other ones that are in sort of the exact same scenario that I just mentioned, that don't have acquisition/dilution risk in the future. Again, to each their own. You will have to invest whatever you feel comfortable with. What is this? Yeah, I don't know why I put this chart in there, but it must be another well that they drilled earlier, and I know what this is. So one of the big arguments against companies and why they have such a high decline rate, public companies, is because they don't produce these wells properly. They don't put chokes on them. They just produce them flat out right away. And they say, oh, we have these massive IP rates, but then you get these huge declines on them going forward. So this is a well drilled by a private company, a mom and pop Southeast Saskatchewan Frobisher well. When it first came on, you might say, oh, this is not that great. It only came on at 80 barrels a day. But this well, 2 years later, more than 2 years later, it's still producing at 40 to 50 barrels a day. So the decline rate is much lower because they choked the well back, they let it flow naturally at a decent production rate without letting it flow flat out. And why I mention this is because a lot of companies that are going to get acquired here over the next couple of years in Southeast Saskatchewan have these sorts of wells. They have wells that are way better, lower decline than you buying a public company. So the Fire Sky wells, the Astra wells, some of the other private companies that are getting bought out, Whitecap bought a couple of them, I want to say recently, are just better wells. And something to take into account into your models going forward is if there's a big private company that gets acquired, their wells are going to have a much lower decline rate than the existing Frobisher, or if anybody buys public Frobisher companies. Just a little side point, there's different ways to produce wells. Just by producing massive IP rates doesn't mean they're the best wells going forward. And the biggest people who make this mistake are shale companies. They just produce them flat out, and then they're suffering from massive declines because they want to show that they have a huge IP30 rate or a huge IP90 rate to the public investors. And overall, it's just poor production planning, poor operations, but that's what the market rewards, and that's what they're going to do going forward. So about 2 hours in, I'm going to run through Petrus quick. So Petrus is a company that only recently kind of came to my attention. It's kind of a unique play. They're doing the same thing, but in the Cardium as rock and soil, so more Alberta focused. 7,280 BOEs per day. Enterprise value roughly 231 million. So trading a little bit cheaper, but they're also more gas focused, about 70% gas. Naturally, will trade cheaper. Everything else here is the exact same. As you see, not much upside torque built in. It's a pretty steady Eddie company. At $100 price environment, you're looking at roughly, call it 100% upside from here. 100% upside. At $120 oil price environment, about a 175% upside. $80 oil price environment, call it 30% upside. They've got some hedges on as well. They are growing production quite aggressively, so definitely we have to put that back in to the calculation. And what we end up with is, at an $80 oil price environment, after we put in the production growth is about 25% of their current production over a year period. So very aggressive growth with this company. And once we factor that back in, the numbers change a bit. So $80 oil price environment, we get roughly $4 a share to 120% upside there. At $120 oil, $6 gas, we get roughly a 3x, more than a 3x. So 225% upside, let's call it. More of a gas bullish play with a little bit of oil baked in there, and a production growth play. It depends how this growth is going to pan out. If they can beat the growth target, it's going to do exceptionally well. If they don't drill good wells, it's going to suffer. So there's a big difference with this sort of company on that. So there's a question here before I go too far. You were not in favor of Saturn management a couple of months back. It's still pretty much the same. Like, if there's two things that are stopping me from investing in Saturn, one is potential of more dilution coming, more M&A coming, and B, I'm just not a fan of the management, the way they structure the company, and some of the governance issues that are around it. So, are they doing a poor job? Not really. Not really. I don't think it's a poor job, but they're definitely taking advantage of the situation, in my opinion, and kind of slow playing a lot of things. So it's not the way that I would like the company to be run. Let's just put it that way. I'm not saying I'm right, they're wrong. It's just difference of opinion on the way the company should be run. And I've never run an oil company in the past, so take that with a grain of salt. I've invested in many, talked to many managements and CEOs, and that's the viewpoint that I'm coming from, not from running a company in the past. So yeah, pretty decent little upside here. Kind of a gas play as well. If you believe natural gas is going to spike this winter, they have some gas hedging, but not, a lot of this stuff is still unhedged. So pretty good place to be. Some oil exposure as well, and fragmented acreage. They've got kind of stuff all over the place. So definitely a little bit. Definitely a little bit more fragmented, more out there. The share structure is really good with Petrus. They've got 130 million shares, 74% insider ownership. So management has all the incentives to get the share price up. The revolving credit facility, 30 million, 6 million drawn, not a big deal. The second lien is 25 million and about 12 million drawn. So pretty good equity-focused company, very low debt. You're not getting the upside leverage on a financial leverage standpoint, but you're getting a lot of not liquidity. You're getting a lot of support from insider ownership in the company. Low debt. It's not even really a big deal. They could even more aggressively expand production if they really wanted to. And so the main play is a Ferrier play, basically Cardium oil, Cardium gas. It's a cookie cutter play. It doesn't get any simpler than this. It's pretty straightforward. 70% gas. They've got some other acreage as well. Glock, Rock Creek, Notikewin, more of gassier plays. We've got Cardium as well. Pretty low operating cost. And again, I've talked about this before. If you've listened to my Tourmaline valuation or some of the other ones, they've got a 60 million per day capacity gas plant, 100% owned, only 30% utilized. It costs a lot. There's a lot of fixed cost running this sort of equipment, compressor stations. There's a lot of fixed cost. If they can get it to 50% full, 70% full, or 100% full, your operating cost doesn't go up that much, as in your absolute operating cost. And you're producing way more BOEs. So your dollar per BOE just gets that much more efficient if you expand these sorts of plays. And gas plants have high capex cost, they have high fixed cost, very low variable cost. So if Petrus can get this play more drilled up, fill up the plant, your operating costs are going to drop by a pretty significant margin. So these are their plays. One thing to watch for here, look at the difference in production. So, only call it, these boxes are 6 miles by 6 miles. So call it from this well to this well, you're only about 10 kilometers away, but these wells are producing upwards of 1,500 BOEs per day on an IP30. These wells, only 10 kilometers south, are producing 500 BOEs. So quite a big difference in acreage quality within their own acreage. These wells on the western end are somewhere in the middle, 800 to 1,000 BOE. This eastern edge is not as good, 600 BOEs. This one was 324. So the gas rates are almost all the same. Okay, so despite the 3x difference in BOEs, the gas rates are all the same, between 20 and 40, call it 25 and 35 decks, E3 and 3 per day. What's the difference? The oil. These top wells are producing 800 to 1,000 barrels a day of oil. These bottom wells are 200 barrels a day of oil. Now you can see why I'm pointing this out. A Cardium well that produces 200 of oil or 800 of oil, that's a massive difference. And it's not just one well, it's pretty clear across these 20 wells that they've given us. So when I say their growth is 1,400 BOEs, what was it? 1,700 BOEs per day. Not only do we need to know, are they going to hit that growth target? We could have a massive outperformance here in the oil liquids rate going forward on these Cardium drills. And if the company's 30% oil versus 35 or 40% oil, pro forma their growth, the netback and the cash flows are going to look very different. And again, worth running models. I don't have them right here, but worth running models on these wells, these new wells. How are they going to be in terms of oil liquids production? Makes a big difference. I can tell you that. It makes a huge difference to the share price projections and the cash flow projections going forward. One of the reasons for this big difference in IP rates is the Cardium itself. There's oil-rich Cardium, there's condensate-rich Cardium, there's a liquids-rich gas Cardium, and then more like of a dry gas Cardium. And they're all smushed together in this relatively small area. We see this eastern side is oil-rich, the green means oil. The western end, where Petrus has a lot of their acreage, is more gas-rich. But these heavy production rate oil wells that have been drilled have been right here. So they've been drilling some very high oil production rate wells in an area that's traditionally known as a gas Cardium area. So they've definitely found something. There's a reason they're drilling in these areas. There's a reason they're targeting these areas. And I'll share about why that's like exceptionally important just a little bit later on here. So, but just keep that in mind. These are some of the older Cardium wells. You can see they come on at 100 barrels a day. They can produce for 5, 7, 10 years, 40 to 60 barrels a day. They're pretty decent wells, pretty good gas rates as well. 4802, so it's gonna be somewhere in here anyway. So pretty decent wells, and a nice part of the Cardium. The Cardium also transitions into 100% water. Not only do you have the oil and gas splits and all that, it goes into 100% water suddenly. Like within a mile, you'll have 100% oil and go to 100% water. So definitely want to also watch for what kind of water rates come out of this well. This is a well that I used to operate, a Modern Resources well. We had 3 really solid oil/gas wells on the pad. We had 1 well that completely watered out. So this is a big issue in the Cardium. I don't know if it's the same in the Ferrier area, but I'm going to look into it a little bit more because it's definitely a problem in the Wapiti area, and it's not well mapped. It's not really all that well mapped. You don't have that much wells to go off of to figure out. So when I see Petrus doing some activity in like new areas, I do want to figure out, is it a gas area? Is it an oil area? And is there water involved at all? Because one bad Cardium well that's watered out could be a big impact to underperforming on production. Okay, here's some Cardium wells, and I'll show you why they're so different. Like, what's this one? I should really label these things a little bit better here. So this is a Wapiti Cardium well, I believe. And what I want to show here is some of the decline rates you see. This thing has declined roughly 95% in 14 months. And it was off for a couple of those months for some sort of problem. This is a Cardium. No, this is their Dunvegan area. So Petrus also went out, if we go up here, and they drilled a Dunvegan well in this Kakwa field right up here. And pretty decent well. It's producing at roughly 400 BOEs per day of gas, and it has not declined for about a year now, I want to say. And there's some other wells here right next to it, which are showing more decline. So the point I'm trying to make, the variability is a lot. When you get to these fringe areas on the outskirts of the Cardium, outskirts of the Frobishers, of the Viking, there's going to be a lot of variability, and the well results are going to be doubly important. Very, very important to focus on these and kind of how they go going forward. So definitely tracking these closely. I don't have Petrus at the moment, but one that I am watching the well results, seeing how they come out, both in the Cardium and in some of these new areas that they're drilling. So certainly worth watching. And I hope I didn't make a mistake there. These are not, I want to say these are, yeah, I think I want to say these are the Cardium wells and this is the Dunvegan well. So yeah, I'm pretty sure this is the Dunvegan well and these are the Cardium wells. So it's the Cardiums that are showing up with low decline rates. The Dunvegan ended up declining pretty hard. So my mistake on that. The dollar per BOED added. So keep an eye out on this. A lot of companies have been saying, oh, look, we have all these synergies. We're going to save money. Our drilling's better. Our completion's better, blah, blah, blah. You're going to see 2022 numbers creep up. To what extent they creep up is going to be quite important. I think a lot of companies have touted efficiencies that just don't really make sense when you think about it. And we'll see which company does the best with inflation, with operating cost, with drilling, securing equipment, securing labor, et cetera, et cetera. The team, they've only got about 12 to 15 people, Petrus, for a 7,000 BOE per day company. Saturn has 70 to 75 people. Different kind of production. One is a workover heavy company, one is a new drilling company. But you can see how the G&A cost and operating cost can get out of hand with some of these workover plays. And it's up to you. That might be a negative. You might say these companies are wasting too much money, or it might be a positive because as the company grows, you can run the same company with the same amount of people with the higher BOEs. So you're saving cost, you're bringing more money to the net back, and the net back goes higher. There's two kind of different ways of looking at it. And Don Gray, the main kind of person here behind Petrus, is the founder of Pado. Pado still runs a 100,000 BOE per day company with only 70 employees. So it can be done. It's not like they're working everybody to the bone and everyone's dying with a workload. Nothing like that. It can definitely be done with the management team that's willing to do it. So right here, we talked about 75% insider ownership. Don Gray has about 25% ownership of the company. Glenn Gray and Stuart Gray, the three Gray brothers, roughly own 82 million shares. Pretty significant. And then BV, this must be a fund or something, or maybe it's a person, owns 12 million more shares. So there's very few shares out there free floating around. And again, you might think that's a good thing. You might think that's a bad thing. But when management is this invested in the company, you can definitely, I definitely respect that as an individual. That's putting your own money on the line. And this is not like a 5-cent company. This is more than $100 million right here that we're talking about that's being put into this company by the directors and management. So yeah, so Robert, thank you for agreeing with me. I was kind of lost there for a sec, but yeah, that North Ferrier well is really good. Yeah, and the Dunvegan well, we'll see what they do there. Hopefully they don't go too crazy on these Dunvegans. They're not that good anyway to begin with. I think I3 has been drilling some good ones, but it's kind of a weird acreage there in the Kakwa. But if they hit some good ones, then so be it. Okay, so coming back to Don Gray, and kind of betting on these outside fringe areas. Don Gray is the founder of Peyto. And for those that know Peyto, for those that don't know Peyto, this is the article you need to read. It's a Globe and Mail article. It's free. It's an open article. Don Gray is the biggest jerk genius in the oil patch. It's a pretty cool little article, Canadian history, but also explains his kind of mindset going about these sorts of plays, what he's doing, and targeting kind of other parts of plays that have been ignored. He's a geologist, I believe, by background. So a pretty cool little article. And I recommend anyone in the Canadian oil patch to read it anyway, even if you're not interested in Peyto or Petrus. Just a cool little article. And this is what he did with Peyto. It was about 10 cents in 1998. It was about $1 in 2000. And they basically just began aggressively drilling parts of the deep basin, the gas fields, and where nobody else would bother, and went into the edges of plays, and very, very strong geologic background to it, well logging, seismic, etc. And this thing was a 50 bagger in about 5 years. So am I saying the same thing is going to happen with Petrus? No, I'm not saying something is going to happen or not going to happen, but I love betting on people who will go out there in the winter, in the summer, climb mountains just to read the geology, pick up rocks off the ground, and then they run their company in that sort of aggressive growth manner. There's not too many people like that out there. You know, people will grow, companies will grow, but in a slow, sustained, kind of predictable manner. Whereas Petrus might go out there and just start drilling these Dunvegans and find something. Start drilling these Cardiums and find something there. They've also got other acreage. You know, Thorsby is kind of a low decline stop, but random acreages in the foothills, you know, small packages here and there, and drill a couple good wells, delineate it, and you're off to the races at that point. So, and he doesn't have much competition. There's very few people going out there and drilling wells in brand new areas so far. So, you know, this graph, kind of a secondary point to this is that a lot of companies made money from 2000 to 2002. The same way a lot of companies and the share prices have gone up from 2020 to 2022. But there's always like 10 to 20 to 40 beggars sitting out there, and the market just does not pay attention. And when I talk about the compounding torque built in, the exponential returns built into some of these companies, here's the same thing in graph format. You know, the picture says 1,000 words. So people will bet against these companies. They think they're garbage. They think there's trash. They're not making money. They too small. They, you know, these workovers are complete junk. Blah blah blah. And all the company has to do is just keep doing what they're doing, and the market will come back. And you can literally see an exponential curve in this graph right here. And that's why I love doing these valuation sessions, because I hope to one day look back 3, 4, 5 years down the road, and you know, there's a graph like this there, except this is 2022 and that's 2025. So that's that. I'll kind of end it there. I think, like I said, this kind of covers the more than 45 or 50 companies I'm tracking. I want to do some other sessions on some junior plays going forward, so I will do that. And then once we get to kind of October, November time, the entire cycle will just repeat. So I think I started doing these sessions around October, November of last year, and I'll just repeat them, do updates on those companies exactly 1 year later, and just keep them going with little sessions on junior companies in the middle of them, and options and macro and kind of everything else in there. And I think that's the best way to kind of go about this and see how these companies have done. Yeah, do some well update seminars and in the meantime, if there's any suggestions, I know there were some suggestions on options and whatnot, but I just don't know enough about options. I don't run these strategies. I don't check the alpha or the beta or the gamma. I just don't. So I don't really want to get too deep into that. And I say something that's inaccurate. But anything else about the oil industry in general, whether it's data or on-field stuff or companies, if you got any suggestions, feel free to send them my way. And we'll kind of go from there. So we'll do a little Q&A period. And if not, we'll kind of end it here and look forward to market open here, the commodity price open. And pretty solid Q2 results, I think, across the board. So we'll just keep on keeping on here. And yeah. So, okay. So the question here is, what is the real reason for running Peyto, Petrus, and Gear with 3 different management teams? I don't really think there's any specific reason for it. That just used to be the model from until about 2020. That used to be the model, is you have a bunch of money, you split it between 5 different teams or 3 different teams, and you give them different assets and you let them run with it. But the private equity model now has moved to the Strathcona model, which is just keep buying companies and merging them into one. So you might see that happen with these 3 companies, but I think investors will make more money if they stay separate, because you merge a Petrus and a Gear into Peyto, you end up with 115,000 BOE per day company. You've lost all your torque on that. So I don't think the Grays are going to do that, to be honest with you. I don't think they're going to do that. And there's no benefit to them anyway to doing something like that. So, but that's a great question. You could ask that for just about the entire oil patch. You could say, why are these companies separate? Why are they not just merged into this big mush and have like 5 of them for the entire conventional and a Canadian shale oil space? Maybe that's where we end up in 24 months or 12 months. You just have this massive M&A, and that's where you end up. Like, look at what Tourmaline and CNRL have done. They've consolidated the entire Northeast BC into one thing. So why couldn't it happen elsewhere? So great question. So yeah, excellent. So Dirk just posted a informal interview with Gray from January. So for those who want to check this out, it's on anchor.fm, and it's with Doc Jones. So Doc Jones does these newsletters on underrepresented companies, like underfollowed companies. So I'm sure that was a really good one. Actually, I have never listened to that, even though I've been sent this exact thing 3 or 4 times. And yeah, and just like Gear and Peyto, they have their monthly results. So they send monthly operational reports on their websites. I hope more companies start doing this, along with operational updates. For those that follow i3, and they tell you exactly well by well what's going on. It's quite helpful to investors to know what's going on with these smaller conventional / exploratory companies. I'm definitely more likely to hold these companies that share monthly updates, because you just have a level of transparency that we've never seen in the oil patch before. Yeah, thank you, Saber. Appreciate it. So, any reason for buying the November 2022 Grand Tira calls? So, I'm going to self-admit that it was a mistake. I think I bought them in June, kind of in the run-up that happened there. And Grand Tira is a company that if oil was to stay at $120 a barrel, with how cheap the stock is, and then you put options on it, and they're doing some exploration drilling, I thought, okay, by November, we'll have some results from these new drills. Colombia has a lot of unexplored oil acreage, not just shale, but even some of the conventional stuff. So, that was my bet at that time. And admittedly, these calls are likely going to expire worthless, but I still gave myself 3 months. So from now, August, September, October, November. Yeah, about 3 months, more than 3 months. So, you know, if there's some significant concern around the SPR and shale declines and kind of oil demand going forward, we look to have hit some sort of peak inflation for now. So you could see the market reverse in quite a hurry. And these things, I don't need them to go up very much for these calls to go in the money. And I don't need them to go up all that much more than that for these to be excessively profitable. And, you know, sometimes you make skewed risk reward bets that don't pan out. So just the way the ball rolls, and we learn from it and we kind of move on. What is going on with the natural gas pipeline in Canada? Yeah, I mean, this has been a problem forever. We've been underpiped in Canadian natural gas forever. And companies go crazy and they just increase production by half a BCF or 1 BCF. It's pretty easy to do in Canada. And then they sit there crying because they're now getting $4 a MCF instead of 6 or 7. And they have nobody to blame but themselves. And I say that with the most sincere message. You have nobody to blame but yourselves. There's no reason that Tourmaline needs to expand production by 3 to 5% a year. There's absolutely no reason. But they keep doing it. And I'm not going to sit here and tell Mike Rose how to run a company. It would be completely wrong and embarrassing for me to even suggest that. But there's no reason for these companies, even CNRL, right? Like, just shut down the gas production for a little bit. Just give it a month, give it 3 months. But no, as soon as prices went up, they went up a BCF a day in like 2 months. And we knew there was going to be maintenance problems, not just within the NGTL system, but within some of the US export into the US systems. And here we are. I don't think there's much more I can say to that. When are you coming to the West Coast? I am on the West Coast, just a little bit further south. I don't really have any plans right now, boss. But you know, I think, like I said earlier, I want to start up like a little San Diego oil and commodity investor meetups. I think there's a lot of people here who want to talk about that, but I don't know. Maybe there's already one on one of the meetup groups, but you know, it'd be good to kind of set up a little base and build my network here now that I'm full-time in San Diego. So you know, anyone who's here and wants to kind of help set it up, even Orange County, I mean, it's not that far. So we're down here, happy to kind of set something up, and we can go for drinks or champagne or whatever, depending on how the markets are doing. So we'll kind of get that set up, and yeah, but no plans to visit Canada at the moment. But yeah. So with that, I think I'll end it here. Thanks again for everyone that joined. Like I said, these will be Sundays from now going forward. The recording will be on YouTube here right away, and we'll kind of keep on keeping on. And I think next week I'm taking off. I got a buddy coming down from the Bay Area, so we'll take off next weekend, and then we'll kind of start again in we have your 28th of August, and I think it's going to be junior company focused, very similar to the Prairie Provident Vital kind of session that I did. I'm going to talk about 2 companies that I bought and the 2 companies that I didn't end up buying, and the reasoning behind why or why not. So that session, I think, was quite well received. I'll put it that way. So yeah, thanks again. Hope everyone else has a great rest of your weekend, and look forward to a great week. Cheers.